U.S. markets were closed on January 19th for Martin Luther King Jr. Day. However, Donald Trump's tariff threats against 8 European countries roiled the markets, pushing S&P 500 and NASDAQ 100 futures lower, while gold and silver hit new all-time highs. When trading resumes on January 20th, trade risks, the divergence within tech stocks, and the ongoing earnings season are expected to jointly dictate the direction of market volatility. Key drivers for tomorrow's session. This tariff threat is the single greatest source of uncertainty for tomorrow's market. The EU has already outlined plans to respond by intensifying diplomatic deterrence and preparing retaliatory measures. Concurrently, a prevailing market expectation is the taco trade, threaten and concede option, which bets that Trump may initially issue threats before ultimately stepping back. The pace of escalation or de-escalation will directly steer the path of risk assets. The divergence within the tech sector is also pronounced. The once cohesive Magnificent Seven bloc is fragmenting. In 2025, only Alphabet and Nvidia outperformed the S&P 500. Capital is shifting from broad sector bets to precision targeting, showing appetite both for AI infrastructure plays and for small to mid-cap stocks with attractive valuations. Regarding earnings season, the market expects Q4 profits for large and mid-cap US firms to grow 10.8% year-over-year, led by the tech sector's projected 19.32% increase. However, financial stocks remain under pressure due to Trump's proposal to cap credit card interest rates. In terms of fund flows and sentiment, U.S. equity funds saw net inflows of $28.18 billion for the week, the highest since last October. Yet the VIX index, a gauge of market fear, is hovering near historic lows. This disconnect from elevated geopolitical risks suggests market volatility could spike at any moment. Market outlook and strategic recommendations. Given the current negative headlines and futures market action, U.S. stocks are likely to open lower tomorrow and trade in a choppy, range-bound manner. Trade-sensitive industrial stocks and under-pressure components of the Magnificent Seven will likely remain weak. In contrast, consumer staples, AI chip makers, and precious metals-related equities could demonstrate relative resilience, supported by their defensive nature or solid underlying industry thesis. Should positive signals emerge pre-market or overnight, such as signs of trade de-escalation, progress in European negotiations, or strong corporate earnings, the market could stage a technical relief rally, allowing oversold tech and financial stocks to recover. A low probability but high-impact scenario to watch for is an escalation in trade rhetoric combined with other negative geopolitical news. This could trigger broad-based selling, sending the VIX index sharply higher and accelerating capital flight into safe haven assets like treasury bonds and gold. In line with the above outlook, investors should prioritize building a defensive portfolio, potentially by raising cash allocations or incorporating volatility hedging instruments. Stock selection should move beyond broad tech sector exposure, focusing instead on companies with clear AI monetization pathways, high earnings visibility, and reasonable valuations. Opportunities arising from the rotation into small and mid-cap stocks should also be considered. For investors with a long-term horizon, a panic-driven sell-off could present a rare entry point for quality assets, though patience is required to wait for sentiment stabilization and technical support signals. Furthermore, tomorrow requires real-time monitoring of 4 key signals: further official European responses to the tariff threat, subsequent White House commentary, movements in U.S. Treasury yields, and the post-open trajectory of the VOEX index. These will all influence the market's short-term direction. Tomorrow's U.S. session will feature a direct clash between geopolitical risks and fundamental resilience. High volatility and extreme structural divergence will be the main themes. Only by remaining vigilant, focusing on individual company specifics, And adhering to investment discipline, can investors navigate the complex landscape, find their bearing, and capture potential opportunities within the fragmented market?